Good afternoon then everyone. We're at the end of another week of trading on Friday the 15th of March. We'll have a flick across the calendar. Relatively quiet start to the week, or extremely quiet start to the week, Monday, Tuesday, Wednesday, and then got into the bit. I say quiet. I mean, we had CPI on Tuesday, didn't really cause much action, but over yesterday and today we have had some pretty sizable moves, which we'll get around to in a minute. Now, main focus of the week, core CPI. We'll get on to that in a minute once we talk about all the US data prints, but you can see UK unemployment rate, UK GDP really didn't make much of a difference to the price of sterling. Some investment banks, some people out there thinking we may get a cut in August. Others think June. People kind of toing and froing before that. But ultimately, still likely to be a little bit longer than the majority of the other central banks. But when we get one from the US, it's a little bit more of a question. I think thoughts for interest rate cuts have maybe been slightly pushed back this week. I mean, you've got two sides to look at things. You've got this week's data prints. We've also got Jerome Powell last week saying we are nearly approaching the time in which cutting interest rates is appropriate. Then you look at also kind of more comments out that he made, noting the risks of keeping interest rates too high for too long and the damage that can do to the economy going forward. You then come into the economic data for this week. In retail sales, we can kind of forget about retail sales, but CPI on Tuesday came in not massively, but a bit hot. Right, core CPI month over month in the course of over the month of February, 0.4. Previous month 0.4, actual this month 0.4. That is still too high. That is not a situation where you have to cut interest rates right now. Core CPI ticked down by 0.1%, but ultimately ticked up in consensus and holds firm of close to 4%, which again is still a bit too high. 0.4% up from 0.3% in the previous month over month. Total rate of inflation, again, that's too high. Inflation 3.2% above previous and above consensus. Sticky inflation numbers on Tuesday, exacerbated by extremely sticky inflation numbers yesterday, where we get PPI 0.6%, previous month 0.3, actual 0.6, consensus is 0.3, but come in double that, come in plus 0.6% on top of the 0.3 from the month before. And that is not a situation where you go and you cut interest rates, right? PPI is 0.6% over the month in February. It's caused some jitters in markets certainly over the last couple of days, and certainly has to, in my view, has to prolong higher rates from the Fed. I mean, you cannot go and cut in your next meeting. You can't go cut in 2 meetings time, especially, and if you get another PPI figure out, you do still have two more inflation prints. By the time we get around to the Fed's next meeting, you got April, you've got May, and then you got into June. So we'll have to see what they come out kind of going forward. But 0.4, the 2 month over month figures in February in terms of the core and headline, and then in terms of CPI and then PPI 0.6. I mean, that's not exactly great, and you would expect some moves off the back of that. Ultimately, start of the week across the board, US dollars relatively quiet. Big downside across your Aussie, Kiwi, Euro and Sterling. Yesterday, dollar Swiss, dollar CAD, dollar yen, all pushing higher. You then come to equities. Equities relatively range bound sideways, struggling up at the highs. You got Apple struggling at the highs. You got Nvidia struggling at the highs. You got Meta struggling at the highs. Amazon, all these big companies struggling up at the highs in their own individual stocks, and then that results in the S&P 500 starting to turn around a bit. You get big downside at yesterday's open, big downside again to today's open. What the open's got why is specifically the open, I'm not quite sure, but first hourly candle of yesterday's session, bang, straight lower. Exact same thing today. Now, it didn't manage to have any follow through yesterday. Follow through came today. Do we get any follow through? We did bounce back yesterday. It's absolutely no surprise that we're bouncing back at the moment. Stocks are a bit insane the way that they're going. You'd probably expect them to be moving a bit lower, but again, markets don't really want to seem to push stocks lower. No matter what happens in markets over the last number of months, stocks are going higher. So be interesting to see, do we turn around and bounce back, or is this a bit more pain for stock indexes due to the fact that we are likely to get a somewhat hawkish Fed in tomorrow's session? Bond yields continue to rally. You can see the 10-year continues to rally, the 2-year continues to rally, both of them pushing higher, supportive for the US dollar. Another thing we need to talk about, I think, is the Japanese yen. Now, there's a Rengo, should I say, a kind of, we'll say, a regulatory board for over 3,000 workers' unions across Japan, and campaign for, above 5% pay increases across Japan, which have been accepted. You've got Toyota that have agreed to the highest pay increases in 25 years. A number of other, workers' union with the kind of governs a bunch of companies and a bunch of the major companies. We didn't get the exact list, but there was a report earlier on the week that a group of the major companies throughout Japan were willing and happy to up wages for strongest wage increases in over 25 years in Japan. Now, why that is necessary, why we need to know that information, is we have had some comments from central bank officials out this week that say in order for them to be fully confident that they're exiting the long period of deflation, they need to see wages rise. Right, what they're watching for and waiting for is rising wages. Right. Wage rises have come over the last week with Toyota, with a number of big companies, with workers' unions agreeing deals for wages to go higher. That is the sign that deflation is likely to end in Japan, and they can move into a period of maybe a bit more economic growth for them, right? And that then brings us forward to next week's Bank of Japan meeting, where we are likely to see them exit negative interest rates, exit yield curve control, all hawkish steps when it comes to the Bank of Japan, extremely hawkish compared to where it have been over the last kind of decade. And you look at the dollar yen and it's rallying higher, which is normally how financial markets work. But you would expect the Japanese yen to strengthen off the back of that. Reason why it's not, though, bond yields in the US continue to rally. Now, they can raise interest rates all they want in Japan. They can remove yield curve control all they want in Japan. But ultimately, US bonds and bonds across the globe have much more of a head start on interest rates than Japan do, right? So as long as US yields continue to rally, there will be no support for the Japanese yen. It's likely to remain under a bit of pressure, even though that we're going to end negative interest rates next week and end yield curve control. I say probably are going to, but we'll cross that bridge when it comes to it next week. So be careful. Don't just go and jump in and buy some Japanese yen because you see them make a hawkish step. You've got to take the market context into consideration. Market context does not really lend itself much support as of right now to some Japanese yen strength. We'll probably get some next week, or we'll hopefully get some next week, with them taking hawkish steps. I'm sure the central bank and the government probably hope they get a bit of a bounce higher in the Japanese yen rather than this thing getting back above 150 again. But we'll cross that bridge when it comes to it a little bit later on. A little bit later on, we'll cross that bridge when it comes to it next week. Bitcoin down 10% from the highs on one day. Absolutely no surprise whatsoever. Reached all-time highs, 2 or 3 times over the course of this week. Down 10% twice off the back of that over the course of this week. So, pretty volatile week on Bitcoin. Continues to trend higher for reasons that we've stated numerous times across these videos. Massive downside yesterday. Does that continue? I mean, you're not going to want to jump in and sell it, but fresh all-time highs reached when, most recently, 7 o'clock Thursday of this week, which Thursday of this week was yesterday, wasn't it? And then, from the high to the low, as you can see, 11% drop in the price of Bitcoin in the space of a few hours, 24 hours. So I'd be a little bit careful about that. But it is a dip to buy back into if you are a believer in the future of cryptocurrencies. Apart from that, oil continues its move higher. A bit of a draw on oil inventories on Wednesday, helping this chart move higher, but not really the main focus of attention. Main focus of attention this week has to be US bond yields, equity markets in the US dollar. Those bond yields ripping at the minute. I'm not sure really why that hasn't resulted in as much US dollar strength. Maybe that's a sign of things to come, but ultimately the higher those yields go, the more supportive it's supposed to be for the US dollar. But again, Japanese yen not really doing what you think it should. US dollar not doing what you think it should off the back of this. It's move higher. Again, it did yesterday, but strange markets at the moment. Probably lying in wait for a massive week in economic data next week. So when it gets around to Monday, we'll have a week ahead video. We'll have a look at that next week, where we've got raft of central banks, a number of important data releases. Extremely busy week when it comes to the economic calendar, but certainly a tricky week of trading. Inflation continues to be an issue. It's likely to keep the Fed hawkish next week. That's the theme to come out of this week. Tricky trading conditions to go and navigate it. Not that much. I mean, not that much US dollar strength. I mean, obviously a big bout of it yesterday, but not really much apart from yesterday. Equity markets, not much weakness in equity markets apart from getting whacked twice in a row at the open. That is big moves at the open. It hasn't really done anything since on both occasions. Yields then ripping through the roof, and that's not really dragging any of the other assets with it. So it's a little bit of a strange one. But anyways, I'll try to wrap my head around it, and we'll see what comes of it next week. But have a good weekend, everyone. I'll speak to you all again next week.